Welcome to today's video on building an aggressive 401k. We will explore whether you should trust a managed solution like a target date fund or build your own portfolio using index funds. We will define what aggressive means at age 30, compare the set it and forget it approach with a do-it-yourself strategy, and lay out practical steps, sample allocations, and the crucial behaviors that matter most. Along the way, we will include diagrams and short quizzes to reinforce your understanding. Now, let's begin by previewing the roadmap for this session. First, we will define an aggressive allocation at age 30. Next, we will compare a target date fund against a do-it-yourself indexed approach. Then, we will cover recommended U.S. and international stock splits and show you practical sample mixes. After that, we will emphasize the behaviors that matter most for long-term success. Finally, we will test your understanding with quick quizzes and summarize key takeaways. To set the foundation, aggressive at age 30 generally means a very high equity allocation, typically 90 to 100% in stocks and 0 to 10% in bonds or cash. Bonds primarily provide stability and reduce volatility, but for a long runway, they can inhibit growth. Therefore, young investors often accept higher short-term volatility in exchange for higher long-term expected returns. With this baseline established, let's transition to the two main paths you can choose. On the left, a target date fund offers automatic diversification, a built-in glide path that reduces risk as you age, and minimal involvement from you. It is ideal for investors who prefer a hands-off approach. On the right, a do-it-yourself portfolio provides control and can reduce expenses, but it requires a commitment to setting and maintaining precise target weights, and rebalancing is needed. As we move forward, we will dig deeper into each option. Now let's examine the managed path. With a target date fund, you typically choose a fund with a date well into the future, such as 2060 or 2065. The fund includes a mix of United States stocks, international stocks, and a small bond component. It automatically rebalances and reduces risk over time via a glide path. This option minimizes decision fatigue and helps investors avoid behavioral mistakes. When choosing among options, focus on the underlying fees available in your plan and select a low-cost offering. Next, we will look at how to structure an aggressive do-it-yourself portfolio. Turning to the do-it-yourself approach, the key is to approximate the global stock market. A common split is roughly 60 to 65% United States equities and 35 to 40% international equities. For core U.S. exposure, a large blend fund tracking the S&P 500, like VFIAX, can serve as the base. For broader total market exposure, add mid-cap such as VEMAX and small-cap such as FSSNX. For international exposure, combine developed markets such as SWISX with emerging markets such as VEMAX. The priority is low cost and disciplined maintenance of your target weights. Now let's outline a step-by-step method to put this into practice. Begin by deciding your high-level split between United States and international equities. For example, 62% United States and 38% international. Then select low-cost index funds to represent each sleeve. Set your contribution percentages to match your targets and enable automatic contributions. On a quarterly or semi-annual basis, compare your current weights to your targets. If the drift exceeds about 5%, rebalance back to target. Finally, consider increasing your contribution rate annually, and make sure you receive the full employer match. With the mechanics clear, let's look at concrete sample allocations. Here are illustrative sample mixes. In a 100% equity aggressive portfolio, you might allocate roughly 40% to U.S. large blend via VFIAX, 10% to U.S. mid-cap via VEMAX, 12% to U.S. small cap via FSSNX, 26% to international developed via SWISX, and 12% to emerging markets via VEMAX. Alternatively, in a 90-10 aggressive mix, you would proportionally reduce the equities and introduce a 10% bond position using a core bond fund such as VBTLX or a short-term bond fund such as VBIRX. These figures are examples only. Adapt to what is available in your employer plan and maintain your chosen percentages over time. Now, let's highlight the crucial behaviors that dominate long-run outcomes. The key insight is that simplicity often beats complexity for long-term retirement investing. If you choose individual funds, align with market weights rather than assembling a random set of funds. Maximize your employer match and increase your contributions as income grows. Rebalance methodically and avoid headline-driven decisions. Ultimately, whether you pick a target date fund or a do-it-yourself mix is secondary to the habit of consistent saving and appropriate risk. This flowchart starts with a question about your preference for simplicity and automation. If that appeals to you, the recommendation is to choose a low-cost target date fund with a distant date. If you do not prefer automation, the next decision asks whether you will maintain precise allocations and rebalance. If that answer is no, you should also default to a target date fund. If that answer is yes, then building a do-it-yourself indexed portfolio with roughly 60 to 65% in United States stocks and 35 to 40% in international stocks can be appropriate. The diagram also includes notes emphasizing low fees, maximizing employer match, and contribution consistency. This timeline depicts a typical glide path in which equity weighting declines as retirement approaches. At around age 30, equity might be approximately 95%, falling to about 85% at 40, around 70% at 50, approximately 55% at 60, and roughly 50% by 65. Bonds rise correspondingly to temper volatility. The exact trajectory varies by fund provider, but the concept is that a target date fund manages this risk shift automatically over time. This mind map organizes the components of a do-it-yourself aggressive portfolio. The United States branch includes large blend via VFIAX, mid-cap via VIMAX, and small-cap via FSSNX. The international branch includes developed markets via SWISX and emerging markets via VEMAX. The process branch highlights setting target weights, rebalancing periodically, keeping fees low, increasing contribution rates, and capturing the full employer match. Quiz time. For a 30-year-old pursuing an aggressive 401k, which equity and bond mix best fits the definition we discussed? Option A is 60% stocks and 40% bonds. Option B is 90 to 100% stocks and 0 to 10% bonds. Option C is 40% stocks and 60% bonds. Option D is 70% stocks and 30% bonds. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. At approximately age 30, an aggressive stance generally means 90 to 100% equities with 0 to 10% in bonds. This prioritizes long-term growth potential while accepting higher volatility. Second quiz. What matters more for long-term 401k success according to this video? Option A is picking the perfect mid-cap fund. Option B is timing the market during news events. Option C is maximizing the employer match and maintaining consistent contributions. Option D is constantly changing funds to chase performance. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Maximizing the employer match and contributing consistently are the primary drivers of long-term results. Vehicle choice matters, but behavior and savings rate typically matter more. This video is for educational purposes only and does not constitute financial advice. Everyone's situation is different, and plan menus vary. Consider speaking with a qualified fiduciary advisor before making decisions. Past performance does not guarantee future results, and all investing involves risk, including the potential loss of principal. Now let's wrap up with a concise summary. To summarize, an aggressive allocation for someone around 30 years old is typically 90 to 100% stocks and 0 to 10% bonds. Target date funds provide a simple and automated solution with a glide path that reduces risk over time. A do-it-yourself portfolio can be cost-effective and customizable, but requires disciplined maintenance. For the equity sleeve, many investors approximate the global market with roughly 60 to 65% United States and 35 to 40% international. Above all, maximizing the employer match and increasing contributions over time are the most impactful actions. Thank you for watching. If you found this helpful, please like the video, share it with someone who is building their retirement, and subscribe for more straightforward investing content. Tell us in the comments whether you prefer a target date fund or a do-it-yourself approach and why. What challenges have you faced in sticking to your plan? Your experiences can help others.